Hello, and welcome to this webinar on Minerva Analytics' recently published 2025 Proxy Season Review. This discussion will examine some of the briefing's key findings. I'm Grogan-Fenn, newsletter editor at Minerva Analytics. I'm joined by Thomas Bolger, Minerva's senior stewardship analyst and lead author of the briefing.
Hi Jack, and thanks for the introduction. And looking forward to talking with you about some of the key findings of the briefing today.
So Tom, to start, can you take us through some of the key statistics from the 2025 proxy season that the review identified and their significance?
Sure. So the analysis looked at three selective indices, which covered, say, the UK, Europe, and the US markets. There's several statistics that stand out. Firstly, in terms of general shareholder support, shareholders are continuing to support management to a high degree. And that's across all markets, with average support standing at around, say, 96%. Although there are differences by region and also by resolution type. So the UK did have the highest level of shareholder support, the US the lowest, and Europe came in the middle. So while the US does have higher dissent than the other markets, so less average shareholder support for management, the market actually did see an increase in support for management, and that was for the third consecutive year now. However, while the US has an increasing level of support, it did actually have the highest proportion of resolutions receiving high dissent of the three markets. So around 4.3% of resolutions in the US received high dissent. And by high dissent, we mean at least 20% or more of the votes being cast against the board's recommendation. And the UK and Europe did both see much lower rates of high dissent instances.
So what changes have there been to the number of and the support for shareholder proposals during 2025?
So yeah, that is one of the key focus areas of the briefing, shareholder proposals. So we looked at how many proposals are being filed, what they're being filed on, and also what levels of shareholder support proposals are receiving across the markets and also by resolution category. So in the 2025 AGM season, the total number of shareholder proposals fell from 600 last year to 553 this year. And this was largely driven by a sharp decline in the number of shareholder proposals filed in the US markets. Because, say, in contrast, the number of shareholder proposals filed in the UK and Europe actually did increase this year. So that reflects different approaches across the three markets in this area. Another key focus area in reports where there is clear market differences is voting on climate. So in recent years, say on climate votes have gained attention, and these are votes put forward by companies themselves rather than shareholders, and that is votes seeking shareholder approval of company climate transition plans. So the key trend identified here is a declining number of companies holding a say on climate votes. And notably, 2021 was actually the only year in which a US company held a vote, and no US company has held a vote since. Additionally, the number of European and UK companies holding a say on climate vote has been declining year on year since the 2022 peak year in terms of the number of votes. So there's several factors behind this trend, and that includes a general loss of momentum for say on climate as investor climate initiatives have faced legal and political challenges recently. Companies may also be hesitant to put forward votes on say on climate due to the risks of high dissent. And in Europe, emergence of votes on sustainability reports may actually be replacing the need for a direct say on climate, as it offers shareholders with an alternative avenue to vote and engage on climate disclosures.
And during the 2025 proxy season, what key shareholder voting trends emerged, and how and why might these trends have differed between the three regions that this report covers?
Yeah, so one key emerging trend impacting voting and engagement is the increasingly contested nature of ESG, that is environment, social, and governance. So this is particularly prominent in the US, where, say, political backlash and also general anti-ESG sentiment is impacting, for example, environmental and social related shareholder proposals. We're also seeing an impact in other markets and also, say, around debates around market competitiveness, which are impacting developments in governance and shareholder rights standards. So there are diverging approaches to ESG issues, And we can take diversity, equity, and inclusion as an example of this, and that's commonly referred to as DEI. So in the US, the striking down of the NASDAQ board diversity rules and also executive orders restricting DEI initiatives has created an uncertain environment for companies and investors to navigate. So this has led, for example, some large US asset managers scaling back their voting policy expectations on US boardroom diversity. And we've also seen US companies scaling back reporting on boardroom diversity statistics.
You mentioned there's been a lot of DI related changes in the US, but what is the landscape like in the UK and Europe, and have there been any dramatic shifts like we've seen stateside?
So in the UK and Europe, there actually are more established market rules around board diversity. So there's the FCA's diversity targets and the European Union's directive on gender balance and corporate boards. So as a result, there is more established practices and expectations for company disclosure and action around boardroom diversity. So as part of the analysis, we did look at, some key governance factors, and that included the level of female board representation at companies. So it found that Europe and also the UK led, with the US lagging behind. Similarly, when we looked at, whether senior board positions are held by a female, so this includes, the CEO, CFO, the chair, or the lead independent director. Again, the UK and Europe led on diversity progress. So the US may now also face increasing challenges and maintaining momentum in this area following these developments. So turning back to now voting results, another area where there's differences across the three markets is the type of management resolutions that actually get voted down by shareholders. So whilst remuneration was a consistent theme for defeated agenda items across all three markets, there's differences in what other types of resolutions get voted down. So in Europe, board-related resolutions saw the most rejected votes. This includes items such as director discharge votes and also director elections. And this was largely due to major shareholders at companies voting down a resolution. In the UK, it was actually capital-related items, and in particular, requests for authorities to issue shares with the disapplication of preemption rights, which were most commonly defeated agenda items. While in the US, interestingly enough, it was actually shareholder rights related items which saw the most defeats. And this was actually due to unique circumstances whereby companies were actually proposing to amend the company bylaws to make governance enhancing amendments, such as the removal of supermajority voting provisions or the declassification of boards. But the companies in question were actually unable to obtain a sufficient majority for the resolution to be carried due to supermajority voting provisions. So one example of this is AbbVie, which have now filed the same bylaw amendments annually since 2018, but it's been unable to obtain the 80% of outstanding shares required to pass the resolution each year. And that's despite the majority of the actual shareholder ballot voting at the meeting, voting in favour of the bylaw amendments.
Turning our attention to climate and sustainability, climate-related shareholder proposals have declined across all three of the markets, according to the report. What do you think could be the drivers behind this trend?
So the analysis points to several drivers behind the decline in climate-related shareholder proposals and also other environmental and social proposals more widely. So some of the key factors include, in the US, anti-ESG sentiments, regulatory pushback, and also legal risks such as lawsuits against shareholders. And they've been impacting shareholder proposals and resulting in E&S proposals being less frequent. The Security Exchange Commission's updated guidance on no action requests has also made it easier for companies to exclude proposals from ballots. So in recent years, there's been a big increase in shareholder proposals being filed. So this may have actually led to companies and investors experiencing some proposal fatigue, especially as some of, the more baseline climate-related disclosures have already been achieved. And this has led to more granular and descriptive proposals being filed, which has a focus on a specific company practice or seek very specific kind of disclosures, which may struggle to gain wide support. There's also been an increased number of anti-ESG proposals, and these typically seek to scale back company initiatives around climate change, DEI, and other areas. So while these anti-ESG proposals have failed to gain meaningful shareholder support, they do contribute to the lower overall average support on shareholder proposals.
Given the proposal fatigue that you previously mentioned, what other avenues do shareholders have to hold their invested companies to account?
So one thing which we've seen in the US, particularly this year, as an alternative avenue to filing shareholder proposals, is investors launching vote no campaigns. And these are campaigns where they call on shareholders to vote against, say, certain directors for issues such as climate change or other ESG areas. And we potentially will see more use of, say, routine votes, say, director elections, report on accounts, remuneration, as a way to raise ESG concerns without needing a shareholder proposal on the ballots. Whilst in Europe, the rise of, say, sustainability votes means that sustainability is actually increasingly addressed through management-sponsored resolutions rather than shareholder proposals. Similarly, say on climate votes, they're also providing shareholders with a direct say on company climate transition plans without needing a shareholder proposal, although, say, on climate votes, still not a regular agenda item.
Looking at the report, governance seems to be by far the leading focus of shareholder proposals in 2025. Why is this, and is it a good thing?
Yeah, so in the last few years, we've seen a decline in support for shareholder proposals on environmental and social issues, but at the same time, an increase in support for governance-related proposals. So there's a few factors contributing to this, and some include governance proposals, such as those seeking to enhance shareholder rights and protections, are generally seen as less controversial than environmental and social proposals, making them more likely to gain broad support. In particular, say, in the US, shareholder proposals seeking the removal of supermajority voting provisions, the right to call special meetings, and the declassification of boards have seen success. And the report did find that it was actually only governance-related shareholder proposals which received a majority vote in favour this year. So the rebound in, say, support for governance proposals may be a reaction to, say, perceived weakening of corporate governance standards, such as relaxed rules on dual-class share structures, increased use of virtual-only meetings, and also reflect a shift in investor priorities and a focus on companies to demonstrate sound governance practices and board accountability in, say, uncertain times.
You mentioned a rebound in governance proposals there. Do you think that environmental and social focused proposals will rebound during the 2026 proxy season and beyond?
So it's possible, but the voting outcomes may vary across markets and also on proposal focus. But in the US, anti-ESG sentiment and also regulatory changes, such as the changes by the Securities and Exchange Commission on no action requests, may continue to suppress ENS proposals in the near term in both what types of proposals make it to ballots and also the level of support received from proposals. And there may still continue to be that strategic shift to more prominent use of vote no campaigns to raise ENS issues rather than by raising an issue through a shareholder proposal. But it's still important to note that environmental and social proposals that fail to pass but still receive a strong support from shareholders do highlight areas in which enhanced corporate disclosure could be material and signals focus areas for investors and boards going forward.
Which emerging trends or topics in 2025 or topics that saw a significant shift this year should shareholders be paying the most attention to, and why?
So in the report, we looked at, say, what the key drivers are behind today's stewardship landscape and identified several factors which we think will likely receive attention from investors, companies, and regulators. So these include, say, developments in artificial intelligence and emerging technologies, the current uncertain geopolitical and economic environments, which is creating a shifting policy environment which is impacting governance issues around shareholder rights and executive remuneration, for example, as well as, say, you've already discussed the changing focus of shareholder proposals and also the regulatory environment for shareholder proposals. And finally, there's also, just to highlight, there's also been developments in, say, expectations for investors in stewardship activity, whether from stewardship codes or increasing scrutiny of asset managers from asset owners. So we are seeing asset owners increasingly review the stewardship activities of their managers for alignment with their own policies and values. In particular, there's been increasing focus on asset manager voting engagement around climate from asset owners.
Minerva's proxies and review picked out a few key trends that we expect to develop in 2026. Why were these particular trends selected?
So artificial intelligence will likely be a key factor next year and beyond due to its potential for transformative changes for businesses, but also it does present material, financial, operational, and reputational risks for investors and companies. So AI has become a prominent focus in shareholder proposals over the last few years, and typically these proposals seek, say, enhanced disclosure on board-level governance of AI, adoption of ethical guidelines, and also additional reporting on a variety of AI-related risks. But there's also increasing environmental framings on AI shareholder proposals, such as requests for additional reporting on the environmental impact of AI data sites. And in 2025, there was a proposal filed at Microsoft asking for additional reporting on the deployment of its AI technologies in fossil fuel extraction processes. So we can continue to expect to see, say, AI span across both E, S, and G. And notably, these shareholder proposals have gained traction from both anti-ESG and pro-ESG proponents. DEI was another item which we picked, which will likely continue to be a prominent feature in voting and engagement in 2026, which we touched upon earlier. We also picked remuneration, which continues to grab headlines and focus. So we've seen several companies in the UK and also in Europe seek shareholder approval to increase executive pay opportunities or to adopt alternative remuneration structures, citing a need to compete in the global talent market as a rationale. At the same time, in the UK, there's been shareholder initiatives around employee pay and proposals filed on living wage practices, which actually have received material shareholder support. So this does highlight the need for companies to continue to carefully balance the need to incentivize and retain executives with the needs of stakeholders and societal expectations, say, around employee pay and also social inequality.
Dual class share structures, or DCSS, were chosen as one of the key trends to watch, and Minerva has this week published a briefing on DCSS. Why is DCSS such an important issue for shareholders to be paying attention to?
So dual class share structures have become a key focus, partly because regulators around the world have seen relaxing rules in this area to attract new listings and promote market growth. However, investors do generally oppose dual class share structures and favour the principle of one share, one vote. There's also a growing push for companies to disclose voting results disaggregated by share class. And this can help clarify how minority and controlling shareholders are voting on an agenda item and whether there's a misalignment between how they're voting. At the same time, investors have also increasingly adopted voting policies and board accountability for dual class share structures and may vote against directors where, say, there's an absence of a time-based sunset provision. Dual class share structures may also feature in proposals filed by companies themselves, such as those seeking to relocate. And we've seen a few examples of that recently, whereby, say, a company bundled an extension of their dual class share structure with a resolution seeking to relocate its primary listing or incorporation. And this bundling of two items together prevents shareholders from being able to, say, directly oppose the extension without also having to oppose the relocation.
Thank you very much, Thomas, for taking us through some of the 2025 proxies and reviews key findings.
Thanks, Jack, and thanks everyone for tuning in today.
Minerva Analytics provides global proxy voting and stewardship expertise. We also deliver actionable ESG insights. Subscribe to our newsletter for updates on our webinar on DCSS early next month and for our weekly articles on ESG investing and stewardship. As we look ahead to 2026, we also invite you to help steer the conversation by completing Minerva's Horizon Scanning Survey. This will be sent out to everyone who attended today's session. Your input will directly inform our research and guidance around emerging stewardship challenges next year. Thank you for joining us today.